digital finance in digital finance in emerging markets, which is a very important topic for us. Pleased to be joined by Zach White, the Senior Insights Manager from GSMA. And Zach and his team commissioned a study on innovations in digital finance in emerging markets last year, I believe. I'll let him introduce himself and speak more about the study and its findings in a second. But before that, I also want to welcome David Krauf. David, tell me if I'm pronouncing your last name wrong or right. From CGAP in the World Bank. David is right in the middle of a study, I think it's almost finished, on inclusive credit fintechs, fintech innovations that have a high potential to fill the MSME gap. And so I think it's really interesting because Zach and his team has done a lot of research around these innovations. And David has also talked about the impact of those innovations and what's holding back the growth of those innovations. So real pleasure to have both of them speaking on this topic with me. But also, we're going to try to keep our quote-unquote presentations and talks as short as possible and really leave it up for discussion, because I do see a lot of familiar names and organizations in the list. And I think it's going to be a really interesting discussion and feedback, and also additional intelligence from the crowd. So with that, maybe we can hand it over to you, Zach, for a quick intro and tell us a little bit about yourself, GSMA, and about the study.
Sure. And just, can I take a cue on time for that one, Jim?
Yeah, perhaps take 5 minutes to introduce yourself and the study, and then we can perhaps move on to David and myself, and then we can open up to questions.
Sure. So there's a slew of links there, which covers what I'm going to talk about. So for those who don't know, I'm going to presume little knowledge. The GSMA is the Global Industry Association for Mobile Operators. Within that, there's the Mobile for Development Foundation, which for about 12 years has worked at the intersection of connectivity and digital services offered by mobile operators and more broadly, and the development sector. One of the main things we do is innovation funding to startups in low and middle income countries who use digital or mobile services or otherwise to develop new and innovative models. I work for the digital utilities team. We focus on core urban services, energy, water, sanitation, waste management, and transport. And yeah, I think the story of why I'm here and the focus of our work is also kind of the story of, inclusive fintech and particularly mobile money. So the birth of the foundation coincided with, the birth of mobile money in Kenya in 2007-8 and its emergence there. And every year since, we've published the State of the Industry report. And one of the reasons my program exists is because we started working in energy through pay-as-you-go solar as, one of the most obvious use cases of combining remotely controlled assets and payments to deliver, essential services that was the demand for and a willingness to pay. So we made about 20 to 30 grants to, now all of the major pay-as-you-go solar players and really kind of trace the growth of the industry. What took us to the report, which is the third link, is because we've seen that those kind of core technology layers move into new financing models. And we've also seen them become more relevant as what was 10 years ago a bunch of scrappy startups has, matured into a global industry serving hundreds of millions of people with energy. I think what we're particularly excited about is where those tools and those technologies combine to de-risk or enable different and new innovative financing models, which is, our connection and how we came to know Jim and Untapped and their work on revenue share models. But I think also we'd highlight, and I think it's maybe relevant to some here, that as these industries have matured, they've been able to take on different and larger forms of debt financing. And the kind of sister graduate model, if you like, further down is receivables financing, which we're really seeing take off in pay-as-you-go solar in particular, with hundreds of millions invested from established investors, so Citi and others, but also with kind of de-risking components from development finance institutions like BII. What excites us most is the potential for similar transitions and new industries around particularly productive use assets and e-mobility. So yeah, really that's the background. It's kind of the potted history of our program mirrors, the development of the sector through the lens of these technologies. And in most cases, that does involve mobile operators as they're the backbone of countries' digital infrastructure. I should say I'm talking predominantly here in the African context. We also make grants in South and Southeast Asia, but most of what I've said pertains to African countries. And I'll leave it there in case I run even further over time.
Yeah, no, I'd love if you could drill down into some of the solutions that the study came across. And we talked about PAYGO, PAYGO Solar, PAYGO moving into other asset types. You talked about RBF, revenue-based finance. You talked about receivables of financing. I'd love to hear more about some of the more innovative things that you guys came across that really stuck out as this is something very interesting and could really scale for the future.
Yeah, sure. I think we discussed 5 instruments from a kind of profile of about 30 that fit our definition of innovative, because that's open to debate what you call innovative finance. But I think there's a pair that I've already touched on, which is receivables and revenue based, and I think they're the key technologies are digitized payments, also having a remotely tracked asset which provides line of sight for funders into the actual operations of the company and the flow of funds. In the case of both revenue share and receivables, you may use an escrow account, or you may have different funders paid off at different stages or tranches, and digitizing that process enormously de-risks it. The second kind of group the second pair that I put together are the voluntary carbon markets, which, as contentious as they are, many startups look to them, and results-based finance, which, has its place with more traditional funders and multilaterals in particular. So in that case, both of those, it's again the digital monitoring and reporting and verification piece that enables a much more effective or targeted delivery of those. So you get more reliable, more credible data in the case of carbon credits, and you also open up the possibility of much more targeted subsidies as well. So, energy and water each have around about 300 billion in public subsidies a year, in one form or another. There's an enormous capture from usually their consumption-based subsidies. The more you consume that service, the more of the subsidy you get. So there's another layer that's very interesting, which is the digital identities, so that you are able to target very specifically the groups that you want to reach. And I think some interesting programs recently that have done that would be Nigeria's rural electrification program, which is in solar, and Togo had a very interesting cash relief program called CISO, which used mobile phone usage to estimate poverty and deliver targeted subsidies based on that estimation directly to people's phone through mobile money. And the final one we looked at is alternative lending to either small businesses or individuals, and the potential of those digital identities again coming into play, combined with the rails of delivering or repaying that finance. So yeah, those 5 instruments. I can't go into all of the details, but
no, of course.
I think I counted them once, and there's about 120 particular companies or startups mentioned in that report. So yeah, it's a rich theme.
Well, I guess my next question would be even shifting to David for a second, because I think some of the work that David is doing right now is very relevant to what you're talking about. It's really about, well, look, there are all these great fintech and embedded finance and pay-as-you-go and innovative, digitally based innovations, but what's holding back greater adoption of these innovations? What do we see? Is it working? Love for David to comment on that a little bit, but before we even do that, did I pronounce your last name right? That's the more important question.
Absolutely not, but that it really doesn't matter. You have to be Dutch to be able to say Cruyff, so
Cliff, got it.
don't worry about that. You can call me David. That's fine. Listen, thank you for having me, Jim. Deborah, thank you for hosting. It's a real pleasure. Could I show some slides? Because generally slides are more impactful than my mundane voice, I would say.
Please.
Okay. Let's see. Can you see my screen?
Yes,
I can't see you anymore, so a verbal confirmation would be nice.
Yes, we can see your screen.
Great. Thank you. I'll try to keep it short. I'm a consultant for CGAP. And for CGAP, I've been looking into, for a couple of years now, into fintech business models. And what I've realized a lot is that there's a lot of hype around fintech, and fintech has delivered on some promises, especially in the payment space, in the remittance space, and the likes. But when it comes to fintech credit, it is really still, everything is still very nascent. And that's a problem because there's a very big MSME credit gap. So CGAP is, for those who are not familiar with CGAP is a think and do tank based inside the World Bank Group. And we do research on financial inclusion. We execute small pilots, and we write research on we analyze results and write reports on that. So we have an opinion about everything that has to do with financial inclusion. I'm in a very small unit within CGAP that looks at SME finance. Within that unit, I look at fintech. So, why did we do this new research? I think so. As I said, for years we have been looking into micro and small enterprise sector, and what we know is that there are nearly 500 million MSCs in emerging markets and developing economies. These MSCs account for nearly all firms and for most of the jobs in these countries, thus making MSC really a critical source of livelihoods for people living in poverty. Therefore, our focus, it's where people are today and where we think the most help is needed, where we can make the most impact. But as with all firms, access to finance is critical to the growth, sustainability, and resilience of MSCs. Yet, unfortunately, there remains a massive credit gap. At CGAP, we have estimated this MSC credit gap to be almost $5 trillion. Now, whether it's actually 5 trillion, maybe it's 7 trillion or perhaps it's 2 trillion, it's not really the point. The point is that it's a really, really, really large number. And the credit gap is actually only getting bigger rather than smaller at the moment. And we also had a publication in 2022 where we really looked at several business models of technology-enabled fintechs, which we believe have the potential to tackle this massive credit barriers, MSC credit gap. But most of these models are still nascent. They are still configuring their product offering. They're trying to determine the best way to reach the underserved MSC community. And these models need time to mature. And to allow for this, they need an appropriate capital stack. So they need the right combination of grant, equity, and debt funding that creates sufficient runway for them to properly develop and test their product before scaling. And what we have seen over the course of the years, however, is that most of the inclusive credit fintechs are severely underfunded, which ultimately leads to a high fintech failure rate. And it also forces those fintechs that do not fail, it forces them upmarket to work with the more mature MSCs, which are already financially included, the lower hanging fruit. So that's why we do what we do. Let me put it on presentation, actually. That would be nice. Bear with me. There we go. This is how it should have been. The business models I've been talking to, I've listed them here. I won't really go in detail in those. But I mean, there are really several different models, ways of approaching MSC finance. I think, yeah, embedded finance will definitely have. You've heard of that before. How that's currently taking up pace. There are a lot of data-driven models. And on top of these direct models for our study, we've also included those inclusive fintechs that provide back office services to financial service providers. So those that work on the digitization of workflows, credit scoring, KYC services, and the likes. The study we did was together with DFS Lab and Brighter Bridges. DFS Lab is venture capital investor in Africa and a research company that focuses on the digital e-commerce. And Brighter Bridges is a data analytics firm that collects and analyzes data of all the investment flows. With Brighter Bridges, we have analyzed almost all the disclosed funding deals over the past decade. And on top of that, we've done quantitative interviews qualitative interviews with 8 innovative investors, amongst others with Untapped, and with 10 inclusive fintechs to understand their fintech funding journey. Now, I think to get to the meat of it, and this is just going to be a high-level overview of our findings, I would like to highlight that, as you can see on the slides, investment into the inclusive fintech sector has increased exponentially as of 2020. I mean, this is a significant increase. This rapid increase is partially explained by the COVID effect, making growth look delayed after 2020, because 2020 was a very slow year, but also the COVID influence, which accelerated the use of digital financial services, helping some early stage companies find their use case and raise capital in subsequent years. But also the fact that some companies are just finally getting into the growth level stage in 2021 and beyond, where they're raising really large amounts, amounts of over $100 million. Think of companies like Jumo, MTN, Halan, Move, or Encopa. And further, we realized that the early stage ticket sizes have gotten bigger, also exceeding an average of $1 million, which is something we haven't seen before. But overall, it has to be noted that there's a very large funding concentration with a limited number of companies. 16% of the companies are good for 90% of the investment volumes. So, the investments are targeting just the growth and successful companies so far still. What have we further seen? We see that there's a large proportion of equity going on as percentage of total funding. Over the past years, we've seen an increase of debt deals, but 70% of the deals are still equity deals. For inclusive credit fintechs, this means that they have little choice, but specifically the early stage companies, they have little choice but to use their equity injections to grow their loan book. And from our interviews, we have come to believe that this is the norm. This is not only expensive, but it also really influences the motivation of the founders as their equity holding continues to dilute. And it also makes them focus on the more easy to service MSC so that it can reach that point of profitability as soon as possible. What we've also seen is that venture capital is by far, really by far the most prominent source of capital available to inclusive credit fintechs, all the way from the pre-seed to Series B. And venture capital always comes with this kind of reputation that they're aggressive and want to see results quick. That might be true in some cases, but hey, without venture capital, there would be almost nothing. So I'm still very grateful that venture capital is investing, but we need more. This is definitely not enough. We also saw, and this is important, that fundraising is a very lengthy process. On the average, inclusive credit fintechs take about 24 months to raise their first disclosed funding, and then 10 months to raise their second round. Most early stage inclusive fintechs are bootstrapped, and they just don't have sufficient capital to keep everything afloat. On top of that, this process is characterized as a continuous fundraising process, where what is typically an already thin management team spends a disproportionate amount of time on fundraising rather than tending to the operational needs of the company itself. Now, this slide really tells a rather bleak picture of the prospects of aspiring early stage inclusive credit fintechs. There they will spend a good number of years of really hard work, much of their savings and much of the money of family and friends, and they'll not make it out of the valley of death. I mean, the drop-off rate is extremely high. Further, we've also heard and seen that this lack of appropriate funding also leads to fintechs going up market. I already alluded to that earlier, but to survive, fintechs are servicing MSCs that are easier to access, already have a digital footprint, and are often already financially included. This is not to say that they don't deserve better and more diverse service offering, but it will not necessarily contribute to diminishing the large MSC credit gap. Fintechs themselves, we put some quotes here, what we heard during our interviews, and you'll see that there are actually several quotes that relate to grants. Because after equity, grants are the most common investment instrument in number and deals, and until 2021, also in volume as well. So close to 15% of the inclusive credit fintechs receive grants from public and private funding. Most grants are received before Series A, and the medium size is around $100,000. Grants are very much appreciated by the fintechs we spoke to, but with the side note that grants are not predictable and you cannot take them into your planning cycle or into your strategy development. In our upcoming publication, we will present many more slides detailing the specifics of the funding flows to inclusive credit fintechs in Africa. But the primary conclusion and important for you to take away is that there's not enough diversity in investment instruments, and equity is the main source of funding. The funding process is very lengthy, and as a consequence of all of this, many inclusive credit fintechs simply just do not survive. Then, my presentation goes on describing how the market is changing and how great it is that companies like Untapped and others are coming in with API connections to their portfolio company and what this all means. But me telling you about that would be doing Jim's job, which he is much better at than I am. So I'll leave it here.
Well, thanks for that, David. And what I really found interesting about your work and results was how much it validates some of the things that we see and believe in the market. In particular, that there is a really strong need for alternative models of investment to make sure the fintechs not only grow, but are continuously serving the appropriate market segments. I always joke a previous experience of large institutional investors coming in and saying, we finance SMEs, but then when we look behind the details, we realize that they're giving the money to the banks who are then giving the money to the same people that they've always been to for the last 20, 30 years. I think what we found with the fintechs that we've seen, we work with, not all, but a large portion of that capital is truly going to new markets, especially informal markets, that is truly having an impact. But I do want to switch a little bit into a quick intro about Untapped and what we do. So a little bit of background on myself. I've been an active investor in emerging markets, including those in Africa, for a while. And one of the things I noticed was exactly this opportunity or problem, whichever way you want to look at it, that venture was the dominant form of financing for these innovative fintechs. But these fintechs, or venture capital, venture equity, wasn't a really good form of capital for them to grow. And so we really started Untapped to meet that specific need. And let me just switch to, if you will, a few slides from my side as well. Can everyone see my screen?
Yep.
Yeah.
Okay. So that's a yes. So repeating a little bit of what David just said and a little bit of what Zach said as well, there's a large gap between venture capital and commercial debt. As an example, if you're producing electric motorcycles in East Africa, you might be able to raise venture capital to build 100 or 200 motorcycles, but getting to 3,000 motorcycles to the point where you are bankable to commercial debt is very, very difficult. And we see that greater than 50% of inclusive fintechs don't make it past the valley of death. So we really see this as one of the main obstacles to fintechs growing better and faster. And so what we've done is to create a investment model that's non-dilutive And that really takes advantage of the two pieces that I think fintechs are really good at. And it was mentioned by Zach and David as well. One is the fact that there's a lot of data, and that data is available through digital means. So we create APIs to have data integration into these companies so we can get data in real time. At the same time, they are using digital payments, mobile money, etc., to capture their revenues. And so there's an opportunity to also make the collections process more efficient by integrating directly into the payment platforms and systems they're using to collect. So the whole point here is, sure, fintechs are great. Ventures got help them prove out some of their models, but how do we then help them bridge the valley of death, ensure that they continue to serve the right parts of the market that need the capital and the credit the most, and do so in a way that truly scales and can deliver commercial returns. And so what we've done is to take these two key elements and turn it into an investment model where we essentially provide that non-dilutive finance to proven inclusive fintech models, whether that be a merchant cash advance lender like Shara, or an electric motorcycle company like Zembo, or a electric truck company like Ox Delivers, and aggregate not only their financing demand, but also aggregate the data coming from those companies, normalize that data so we can analyze it at scale, and also aggregate the financing streams that come through them. We believe that what that offers international investors is greater scale, obviously the transparency at greater scale, but also the diversification to make sure that investing in these volatile markets is worthwhile. So that's really at a high level what our company is focused on doing. And really, I see our raison d'etre as to scale successful fintechs so that they can serve more of the most underserved markets in informal markets, and really create a more prosperous future through shared prosperity. So that's really our goal. So I'm going to stop there for a second because I know there's loads and loads of questions that I've seen through the chat field. So maybe we can start on some of them. Deborah, would you like me to just pick some of these questions, or would you like to go through some of them that you might have already seen?
I need to unmute myself. I've got two screens, so moving my mouth to the other side takes some time. Yeah, please pick a question, Jim, if you have any you want to answer, also for the other speakers. And I just want to also let our participants know that we are now opening the Q&A round, so you're very welcome to just unmute yourself and ask your questions or type it in the chat field.
The one that I saw that I thought was very relevant is, and I'm going to stop my sharing once here, is Boris's question about metrics to substantiate the redistributive intent. So are we just giving money to fintechs and they're just giving it to the same people that are already getting money? Or is it reaching new audiences truly? Do we have metrics around that? I mean, I think I'd love to direct that to both Zach and David. And I can say from an anecdotal perspective that it is truly reaching new markets, especially informal ones that were previously not digitized. Zach or David, would you like to address that question?
Yeah, sure. I mean, I think I can talk most accurately about our innovation funding portfolio. So I maybe should have said from the start, we're supported by FCDO. So within the GSMA, we're an independently registered 501c. So yeah, we have a really strong impact metric, and within the grants, we do both in terms of how we choose them and monitor during the grant period. We do look at those questions with, you know, first time adoption of financial products being like a pretty core one when relevant. But I think the main way that I look at that question is to actually look at the service and the market context itself. So, for example, we make lots of grants in waste management, or have recently made lots of grants in waste management using digital services. Stepping away slightly from fintech, but you know, in that example, the baseline is a complete absence of those services. That very much applies if you talk about first-time access to energy or like very clearly improved access to water. And I think kind of tying back to the fintech discussion, you know, often it might not be credit provided directly to an end user, but the use of a pay-as-you-go service, you know, for someone who doesn't have a smartphone, to buy a productive use asset of a particular class can often speak for itself. I think the question does get a little bit muddier when you take examples like Mcopa, for example, who began in pay-as-you-go solar and recently pivoted exclusively to focus on smartphone financing. I think there's a question that should be asked around who that customer base is. There will inevitably be people for whom, you know, that pay-as-you-go option is enabling an access to a digital service, but there will also be a chunk of that customer segment who are, you know, comparatively wealthy for the market context, or even absolutely. So yeah, I think, I mean, it's a very open question, but I think it really does depend. I think for us who look kind of beyond just fintech solutions, I think often the service and the market context speak for themselves. But you know, within the context of our own funding, we track it quite rigorously through end user surveys and the such.
Thanks for that, Zach. Another question from Barris, in case anybody else wants to ask from the audience, please chime in. But the other one, comments / question, I'll just read this, Barris, and if you want to jump in to clarify, feel free. Fascinating that the question is about current financial products not meeting the needs of inclusive fintech lenders, rather than whether we have the products that are accelerating the transformation of outdated and destructive systems. I think that's a very insightful point. And we had a fairly long discussion in the roundtable with David and the other fintechs who were involved. And I feel very strongly about this because you know, we are trying very, very hard to create alternative products that fit the needs of the fintechs versus making the fintechs adapt to a broken financial system. But I can simply say that the finance world is very conservative in the sense that anything that does not look the same as everything else in the past makes it very difficult for commercial finance or mainstream finance to accept. So I think that's one of the challenges. But I'd love to hear from David, because I know you've heard from many fintechs and even funds that invest in fintechs. Any insights there for Barris and others? Oh, you're on mute if you're speaking.
I tend to do that a couple times in each session. So this was the first. But anyway, I can't add much because Barris really hits the nail on the head there. I mean, the system is broken and outdated when it comes to wanting to make progress and solve actual real world problems. I mean, it's not only broken, it's getting brokener, if that's the word, It was broken and now it's even more broken. In a sense, banks are inherently risk averse. That's just what they are. And they have increasingly less incentive to make risky investments if they can invest their money in T-bills and the like. So I don't expect much from banks. Now, specialized banks like microfinance banks and other MFIs who should be lending to MSMEs, they have gotten a psychological damage since COVID, I think, because since COVID, I've just seen a lot of these banks closing shop in rural areas, going to urban areas, doing more of the same of working capital loans to retail sector, which is where the banks are also venturing in. And, I just don't see anything growing there or adding value either. So, I mean, fintechs have the opportunity to really change this, but they're not being, they're still, I mean, I'm not saying you should invest, that everybody should invest in them, because those can be very risky investments. So we have to find a balance between, how much risk can you take and how can we provide them better products. And I think what Jim is doing with Untapped, but there are several other companies that are going down the same route with the API connection. What it really does is essentially is that it really gives you a way better, a way better option of monitoring your risk of your investment. You have real-time access to data, you know exactly what's going on at the real time. you can stop that funding from the moment you want, or you can better know where to adjust things or where to look at. And not only that, if you start with $50,000 rather than a $3 million loan, your risk is already much lower. You know what I mean? So yes, I think what Jim is doing together with a handful of other companies, it has the potential to really be a game changer, and that's why I'm so excited about it. And when I'm now at a conference on investing in Africa here in London, and there's a buzz going on. There's a buzz. I see that a lot of the investors are interested in this, want to know more about this, and thanks to Jim and some of the other companies doing that, there's already quite some traction to show that it works. So I mean, I'm really excited about it.
Just one comment there. Thank you for those kind words, by the way. I appreciate that. I think one of the things about technology, I just call it very generally technology. So whenever there is a new technology, it takes industries a while to adapt their business models to the new technology. I always use the analogy that when the internet came along in the mid-90s, the newspapers just put their newspapers on the internet. It took Twitter and others to come by to truly disrupt the business models. And in a similar vein, in finance, what we see is very similar. People are saying, yes, we use data for finance decisions, but do they really? Of course they do, but are they truly using the advantages of this real-time data and API data? So one of the things that we do is a little bit different, and it takes a lot of explanation and trying to change people's thinking, especially funders thinking around this, for it to sink in. So instead of doing all your diligence up front and deploying large checks up front, if you have the technology to monitor what is happening with the company on an ongoing basis in a way that is scalable and real time, then you can change how you disperse capital and how you do due diligence and how you do monitoring. And I think that's a fundamental shift in how you manage risk. So instead of trying to manage all your risk up front and do it through collateralization and everything else the banks will do, you do it through the data. And so I think those changes are going to come. They're going to take some time to come. But I think my ask to the audience really is, and this was alluded to, I think, in Varys's question and some others as well, which is, how do we accelerate the mind shift in the finance sector, right? I mean, it's self-serving for me. How do I make it easier to explain to people about what data-driven finance is? Is there some blended finance models that can help incubate data-driven fintechs, help them cross the valley of death? Can we apply this model in a impact-oriented setting to ensure that more companies become commercially viable? So I think that's my challenge, or my question, if you will, to this audience, and to see if we can tackle that together as a group.
And while the audience is thinking, we have a question also from Stefan, who's asking, given urban MSCs are easier to access, denser, more connected, and etc., what are some of the example and best practices for reaching rural clients?
I'm happy to answer something, but I'd love to see if Zach or David has examples. I don't want to.
Well, I can start by if we're staying in the fintech area and seeing what fintechs can do in terms of MSC access to credit in both urban and rural areas, it supplies. I don't believe there's a tech-only solution. I think we're at least a generation away of public understanding, the clients understanding tech properly, and also of the digital public infrastructure being at a level that you can have only tech-only solutions. The solutions that really work, in my experience, are what we call high tech, high touch. So you will still need a force, feet on the street, let it be a sales force, an onboarding force. You need people on the street to explain how the product works, to onboard people, to ensure that people know what they're getting into, what a loan means, what the responsibilities are. So it's a long, it's a long game. You need to have patience, and the best examples I've seen are always ones that embrace the high tech, high touch business model. Whatever model they have, if they don't have a touch element in it, it's going to be inherently difficult to really pull off.
Right.
I
Do
don't
you
have
want to comment, Zach, as well?
I
Okay.
really don't have much to add. It's not within my area of expertise. We have an agri-tech program, which I think is, and a digital inclusion program, which is our predominant engagement in rural. So, you know, the focus of our work in rural areas is on digital skills and agricultural services, neither of which I can competently speak to, so I won't try to.
There are interesting embedded finance models in ag tech serving the agricultural sector. But what I would say is that for a lot of these solutions, and yes, Stefan, I agree, there is a urban bias simply because there is more adoption of mobile technologies and mobile money in urban areas. But you know, when you look at our portfolio and the fintechs that we support and finance, there's actually a fairly large percentage that spill over, if you want to call it that, into rural customers. You know, that includes we finance, for example, point of sale systems that local merchants use to accept digital money and become cash points for their community. And yeah, sure, of course, there's a lot of urban customers, but a lot of those also reach more disconnected rural customers. You know, similarly with some of the merchant lending that we do, and one of the reasons why the merchant or the data-driven merchant lending is so effective is because of that distance and ability to oversee and monitor those risks from a distance. So the rural component is not insignificant in these fintech models. So I don't think we should underestimate the spillover of technology into peri-urban and rural areas.
After saying I wouldn't say anything, there's one point I'd like to add, which is a big area of focus for our program, which is urban focused, is African intermediary cities. And I think there's a big question of what rural is now in the context of where most of the world's population growth is going to happen between now and 2050. So, you know, the population on the African continent is going to explode. And it is about half of that growth is going to happen in cities that are currently under 1 million people. So, you know, there's going to be new mega cities, of course, but there is also going to be hundreds of emerging cities across African countries. And I think that transition and the interface between the rural economy and the urban economy, particularly in the movement of foods, but also goods in the other ways, is a big question for the continent. And also, you know, urbanization without growth being a real risk, but also a lot of these currently rural areas representing enormous growth markets for companies now only operating in capital cities. So,
Angie, I think it's a question. You know, is the urbanization of African markets everyone moving to the existing urban areas, or is it urbanization of previously rural areas? So I think it's a distinction that's important, because we all romanticize the smallholder farmer, but you know what's truly happening on the African continent. It's maybe slightly different than our imaginations. I do want to go back to the question I asked the audience earlier about, you know, are there, and I'm sure they're great examples of this, are there examples of blended finance models where without pushing aside or displacing commercial capital or creating greater distortions in the market, but are there blended finance models that can help these fintechs grow faster or cross the valley of death? Anybody from the audience like to chime in? Okay. Well, not to be self-promoting, but I'd love to say that that's one of the things that we're trying to do at Untapped, which is how do we take not just a commercial approach and deliver commercial returns while supporting these fintechs, but we think that there is a blended finance opportunity to incubate more data-driven companies. You know, again, you mentioned the number earlier, David. The 160 some companies that you might have looked at, many of them will die, and I think there could be more done to help the ones with proven business models that can truly serve the right market, but simply just can't find the right financing, continue to grow and bridge that valley of death. So I think that's where we should be putting all more attention.
Jim, I agree with you. I think that there should be a role for DFI community to play here, specifically when it comes to accelerating concessional capital and blended finance. They themselves might not have concessional capital, but the donors that they work with do. So they should be thinking more in terms of structured funds, first loss positions in these funds, and certain guarantees to be had over these funds to really promote these emerging fintechs. A problem, and I'm having these discussions with DFIs, every time I meet them. I think a problem that I often see with DFIs is that there still is an attitude is like, why would I throw money away at these early stage fintechs? They don't even they didn't even prove their product yet. I will just invest with the ones that are proven to be successful. And I find it difficult still to really convince them that this is worth it, that they need to understand that if they don't make more effort, a lot of potentially good ideas will not come to fruition. And if you only invest those that have made it, you're investing only a certain type of fintechs that are only investing in a certain type of MSCs. It's a very narrow focus in the end. So I think this is an ongoing discussion which really needs to be put to the forefront. And CGAP will do more on research for blended finance next year. So hopefully we can help.
Well, I'd love to just plug some ideas that we're considering. We're looking at, as I mentioned, we have this aggregation platform, a data aggregation platform, bring fintechs together. And we developed a commercial portfolio of companies where we've established the monitoring infrastructure and validated their ability to scale and so on. But we would love to do more with the fintechs that are not quite ready to scale yet. And I believe that needs to be a blended finance facility. And so I really challenge anybody on this call to say, if there is an interest in seeing more proven fintechs scale to the point where they can become more commercial, we'd love to lead an initiative around building that facility. I call it an incubation facility to really grow more, help more of these inclusive fintechs reach scale.
And I don't know enough about it, but what I always want to know more about is there are so many incubators and accelerators also on the African continent, but globally. Why are they not having more impact?
Well, can I answer a quick question on that one? And
yeah.
Sorry, this is very self-serving because it talks to, I think, our proposal here, is a lot of them are venture fund incubators. Right? So you go through, you do your incubation, you do your coaching, and then you learn how to raise venture capital. Well, it's like getting your college tuition paid, then you graduate and you don't have a job. It's really hard to secure venture capital. And so what we're trying to drive is, hey, let's create the offtake. Let's create the clear terms and conditions and commercial capital that's ready to finance the graduates from these incubation programs. Let's bring more students into this incubation program so we can put more into the commercial funds and to funnel to other commercial banks.
Do you think that these incubators or what have you, that they need a certain quality control or standard so to match also what follows up? Because there's this wild growth of so much going on. It's difficult to see what's really working and not.
It sounds like it's a topic for another conversation.
Yeah.
Sorry for that.
I think there's a grounding fact that a lot of the kind of home market VC funds have absolutely brutal terms. So if you're in Nigeria, 7% for $20,000 to $25,000 is not uncommon. So 77% of active investors on the continent are foreign, with much larger ticket sizes for much less equity. So I think the question of why nationally established VC funds are struggling is, there's a very uneven playing field, and companies going through a lot of those funds do so with a runway that is much shorter than if you access international capital. The same doesn't apply in India, where you've got plenty of homegrown VC funds that are launching unicorns. So I think it is something particular to the African investment dynamics, and whether or not you're doing a good job, there is just ticket size. It's a brutal fact that, you know, if you accept those terms, they are quite punishing.
Yeah.
Yeah,
Can I just highlight a comment from, oh, sorry, Deborah.
No, there's just one question from Glenn Jordan to answer for you, Zach and Jim. Based on the rapid urbanization and city growth, is there appetite for mortgages alternatives, long-term data-based housing finance?
I haven't seen data-driven housing finance, but I would imagine there is some opportunity there. Although I think one of the things that we focus on is productive capital, i.e. capital that helps small businesses make more money. I think one of the issues with housing finance is ultimately how are you going to pay for your housing? And if you don't have a close monitoring or link to that, the risks are still there. So data is great, but I think at least in my conception, the golden ticket is to help emerging markets, SMEs and emerging markets make more money so that they can ensure they can get more finance.
Yeah, I'd add that I think the housing market is a particularly difficult one, because, you know, the value of the asset, also land, and the different regulations between different markets, but tending towards larger assets and long-term financing through debt or pay as you go, you know, that is a definite trend which will continue. And I think in the conversation of fintech, debt doesn't come up quite as much as talking about different kinds of digitally enabled finance. So in any of the utility sectors, or for example, e-mobility or logistics, you're going to have large capital outlays. You can't fund that entirely off venture raises. The pay-as-you-go solar sector did it to an extent, but just dropped a link to an excellent article Dan Waldron wrote on debt and its mix in the funding. But I think for a lot of the asset classes that are being moved into, you know, bigger like microgrids, like large scale waste processing, electric buses, you're going to need a lot of debt as part of that funding mix. And it kind of goes back to the question asked earlier about the role of blended finance. You know, guarantee losses, like, you know, giving over the senior debt to more commercial investors. Absolutely, this is how it's going to happen. Or how it can happen, one of the options. So yeah, I guess my last contribution would just be to maybe support the intuition of the question, which is the need for debt, and applied to larger assets. Most definitely, housing has its own difficulties.
So I have a question for Deborah before she concludes. So there's a comment from Juliet Waldinger. The session was packed. We have to go back, and she wants to go back and reread the recording. I'd love to continue this conversation, and perhaps there's another opportunity to dig a little bit further in some of the specifics that were brought up here on this call.
Mm-hmm.
And if that is interesting to the audience, I'm very happy to continue the conversation in the group.
So I totally agree with you, Jim. I see people are getting warmed up now, and it's just when we have to close the session, which I'd love to keep on going. But why don't I will do a follow-up note anyway with the recording. And maybe, David, I don't know if it's possible to share your slides. I know the study is not completed, but is it possible to share some of your findings with the crowd? And maybe I'll be also gathering the links that we have there and share that. And so anyone who's interested in, we can do a session 2 also, what we've been doing in the past, going deeper into certain areas. So if you have comments and ideas that you'd like to share with us, happy to get together a group, and then we can see how we can take this discussion forward.
Deborah, just to answer your question, I can share some slides, but there's some ground rules here. You didn't get them from me. That's the rule number 1. Rule number 2 is please don't share them with other people, because you know, CGAP wants to have that big momentum that our publication comes out
course.
and everybody's happy. But, you know, CGAP takes quite long. It's in the World Bank. It'd be weird to wait for it. So I'll share some, but just treat it a bit with some confidence.
And do you have an ETA for when that might be publicly released?
I hope it's going to be a Christmas present, but you know, I still have to finish the draft, so I'm working hard on that.
Well, that's not too bad.
Yeah, well, probably January. But
Amazing. And within this network, I mean, I guess one of most important parts is that we connect people. So if there's anyone in your network that needs to know Jim, Zach, or David, or anyone else that was in the room, please make sure that you connect and introduce those people. And if there's anyone in your network that needs to see the session today, please make sure to share the link of the recording, so we can all help each other do our work better. I think that's how we can move also the needle faster. So thank you everyone for joining today. Any final comments, Jim, Zach, and David, before we close? Thank you very much to the three of you for this very insightful session.
great to be here. Thank you for having
Enjoyed
me.
it.
Thank you, everybody.
Take care, everybody. Bye.